One of our viewers asked this question: how much should I invest? Let's take a look at the full question here. On August 10th, I started investing in dividends through a robo-advisory. I put $6,000 into a Roth IRA, 90% stocks. That has grown 10%. I recently put $10,000 into a 90% stock taxable account as well. I make about $20,000 per year, with my spending being about 50%. What percent should I invest and what percent should I save? Thank you for watching. This is Richard with Wisdom Investor. We're going to take a look at this viewer's question on how much he wants to save and how much to invest. One of the things he mentioned was a robo-advisory. So what is a robo-advisory? From Investopedia, let's see what it says here. Robo-advisors provide automated, algorithmic-driven financial planning services with little to no human supervision. A typical robo-advisory collects information from clients about their financial situation and future goals through an online survey, and then uses that data to offer advice and automatically invest clients' assets. So this viewer is using a robo-advisory, and they're getting a second opinion by asking us here, what percent should I invest and what percent should I save? By the way, if you have any suggestions what this person should do, leave it in the comments. They're much appreciated. What information do we know about this viewer? We do not know the age. So we're going to do a scenario if this person was above 50 and a scenario below 50. Goals, they want to save $10,000. Right now they're using a Roth IRA. Definitely recommend maxing out a Roth IRA. There's no tax on the withdrawals when they go to retire. Risk tolerance is medium to high. Since they say they're investing in dividend stocks, so they obviously want to invest in the stock market. Total assets, we don't know. The question here was what percent in savings. We don't know how much money they have saved up, but they definitely want to have at least 6 months of living expenses in an emergency fund. And I also recommend keeping some powder dry, keeping some of the money on the sidelines for a buying opportunity. And I'll show you why. Here's the S&P 500. S&P 500 is at its highs. Typically, it will come back down to the 250-day moving average. So I would keep some powder dry so when this market comes back down, they can buy low and sell high. They last bought in August, so that would have been right around this area here. What percent should I invest? In this scenario, age 50 and below, invest 100%. And the only other thing I may add to his dividend portfolio right now is diversify with an international fund. Here's what Vanguard Investments recommends for a person looking for growth. An 80-20, 80% stocks, 20% bonds. Historically, that allocation has had a return of 9.7%. A portfolio of 100% stocks has had an average return of 10.2%. Now, if a person's below 50 and maybe they don't want to invest in individual stocks, here's a portfolio that could be used. Vanguard High Yield Dividend 40%, Schwab US Dividend Equity 40%, and Vanguard Global Equity 20%. This would make up 100% of the equity portfolio. Again, we did say start putting some money in cash or keep money dry just in case we get a dip in the markets and we can reinvest at a lower price. Now let's look at the situation if this person's above 50. What we recommend in this case, 50% stocks or ETF or mutual funds and 50% income funds. Here's what Vanguard recommends for a balanced portfolio. 50% stocks, 50% bonds, has an average annual return of 8.6%, or 60% stocks, 40% bonds. The reason we want to have some money in the stock market is inflation. If inflation increases, you want your money to grow with inflation. So if this person is above 50, we're suggesting 50% equity, 50% and an income portfolio. And then of the equity portion, they could break it up into the Vanguard High Yield, Schwab US Dividend, and Vanguard Global Equity. And as far as the income funds, a portion of this they could put into a certificate deposit and also a short-term bond fund. Here's some examples of some shorter-term bond funds. Vanguard Ginnie Mae, Double Line Short-Term Bond Fund, Osterweiss Strategic Income Fund. These short-term funds have a low duration, and I'll explain in a moment why that's important. For a person that wanted to be a little more aggressive, they could use some closed-end funds that could generate 6 to 10%. Those pay interest monthly. Also, for the more experienced person, covered call strategy can generate some outstanding income. And then QYLD is a covered call ETF that generates income monthly. Now let's take a look at something we need to be thinking about here right now. In this portfolio, we talk about 40% bond. We're looking at the TLT bond fund. On the left side here, as interest rates were moving lower, bonds, especially the long-term bonds, were moving higher. Interest rates have been creeping up and long-term bonds have been moving lower. Here's the Vanguard Total Return Bond Fund. You can see here, prices going up as interest rates were moving down, but now we're starting to see interest rates creep up. So we want to be real careful with bonds, especially longer term bonds. If interest rates move higher, the bond prices are going to move lower. Here's the 10-year U.S. Treasury yield, and you can see this is starting to move on the upside. So that's why I have some lower duration bond funds here. These won't be affected near as much as a long-term bond. So you have to think about that if you're going out and buying bonds right now. Now, a person might say, well, I much rather have individual stocks. I don't want to invest in an ETF fund like Vanguard High Yield or Schwab US Dividend. So what stocks do you invest in? Here's some of the holdings for the Schwab Dividend Equity Fund. You can see these are some high quality stocks. Schwab Dividend Equity Fund has advisors that pick their stocks here. And so these are a good list of stocks to look at. If you go and look at the holdings of some of these ETF funds, you'll see what stocks they like. Here's the Vanguard High Dividend. You can see some of the stocks that they like, and it's a little bit different than the Schwab. So investing in those ETFs gives you some diversification, but if you want to do your own stock picking, here's some of the stocks that are in the Vanguard High Dividend. So after viewing this video, maybe you're thinking, I want to rebalance what I have right now. I want to change a little bit of what I'm doing. If you are rebalancing your portfolio right now, moving from one equity to another equity stock, you can just transfer 100% of what you own or the balance. If you're just starting out, you're watching this and you're just starting your investing program right now, what I recommend that you do is dollar cost average in, or wait for a better buying opportunity when the price drops. So for this investor, recommend that they make sure they have an emergency fund, put some cash aside, save some dry powder for a good buying opportunity. If they're below 50, go with a 100% portfolio in dividend stocks like they're doing. Add the Global Equity Vanguard Fund or their fund of their choice. If they're above 50, then use a 50-50 ratio of stocks to bonds. Use shorter duration bonds right now. Make sure you have an emergency fund, and also keep powder dry for a buying opportunity down the road. Thanks for watching. If you have any questions or suggestions, leave your comments.